Thank you for joining us today for our webinar, Coronavirus and Employee Benefit Plans, Practical Considerations for Employers. For those of you that have been part of the McDonald Hopkins group or clients or referral sources and friends, you know we've done business hours and many times, and this one's a little unusual because you had to bring your own peanut butter and jelly sandwich today because we're not feeding you. I'm Dale Vlasic. I am a member and the head of the Employee Benefits Practice Group at McDonald Hopkins. With me on the panel today are two of my colleagues who are also members of our Employee Benefits team, Tony Pilsner, and John Wirtschafter. We're not able to take live questions during our discussion. However, we will be happy to address questions from the audience at the conclusion of our presentation. You can submit your questions by emailing events@mcdonaldhopkins.com at any time during the webinar. If you submitted questions in advance of today's program, we're going to try and cover those as part of our discussion. Before we begin, I'd just like to hope that everyone and their families are doing well in these challenging times. And we hope, and the firm hopes to be able to be with you and work with you shortly. One of the issues in terms of plans that we're seeing a lot of questions about, and obviously there's a whole lot of guidance about, is there's money sitting there and people want to get at it. And Tony, can you tell us what options we have available for folks?
Yeah, the option that has been getting an awful lot of press and attention is the coronavirus-related distributions. Now, there are two aspects of this under the CARES Act. The first one provides that a qualified individual, who we'll describe in a minute, can take up to $100,000 from their qualified plans and their IRAs in 2020 and not be subject to the 10% early distribution penalty. In many cases, this money was already available for withdrawal, but they're not going to have to pay that 10% penalty. You still have to pay income tax on it, just not the additional penalty. Now, this exclusion will apply when somebody files their 2020 tax return and when they report their withdrawals and whether those withdrawals are subject to a penalty. Now, this applies to a distribution from a qualified plan, like a 401k plan, even if the plan doesn't designate the withdrawal as a coronavirus-related distribution. The plan hasn't set up a new category of distributions we're going to talk about in a minute. It's any distribution that you can take from the plan that would otherwise be subject to the penalty. If the individual certifies that they're a qualified individual, they don't have to pay the penalty. For example, if they have to take a hardship distribution to pay medical expenses for a spouse who has been diagnosed with COVID-19, they can do that under most plans' current hardship rules. But they would not have to pay the early distribution penalty as long as they certify that they're a qualified individual when filing their tax return. That exclusion from the penalty applies regardless of what the plan decides to do with setting up coronavirus-related distributions. It's available to anyone for distributions from their IRAs or their qualified plans. You would take the distribution into income on your tax returns over a period of 3 years, and you also have the ability to repay those distributions over a period of 3 years. Now again, this right is independent of whether the plan decides it's going to set up this new category of distributions. So you could repay the money to your plan if you've identified yourself as a qualified individual to your plan, or you can repay it to your IRA over the 3-year period. The CARES Act also allows plans to set up a new type of in-service distribution called a coronavirus-related distribution, or CARES Act distributions. Now, these would be in addition to the plan's other existing in-service withdrawal provisions, such as hardships and age 59 and a half distributions. Some plans also allow folks to take out rollover distributions at any point in time, and some of them allow employees to take out employer contributions before age 59 and a half. So these CARES Act distributions would be in addition to those existing types of withdrawals. Now, a plan can allow a participant to take out up to $100,000 of their vested money. Now, the plan doesn't have to adopt the full $100,000. The plan could impose a lower limit. It's not required to allow these up to $100,000. And the plan administrator is specifically permitted to rely on the participant certification that they're a qualified individual. So once an employee certifies that, does the plan administrator have to do anything else with that? Well, we don't have any guidance on that. The presumption would be if the plan administrator knows that the facts the participant is presenting are false, the plan administrator may have an obligation to deny the distribution. But as we'll talk about with qualified individual status, depending on how that certification is done, the plan administrator may just have to take the participant certification and make the distribution. Again, the plan would have to allow the distribution to be repaid over a period of 3 years. We're going to need more guidance on that in the future because of the confusion right now as to how those repayments are going to be reported by the plan as a repaid amount so that the participant can go back and treat the originally taxed amount as a non-taxable rollover distribution. If you have more than one plan in your control group and one person can participate in more than one of those plans, the plans have to coordinate amongst themselves to make sure that the $100,000 limit is not exceeded when taking into consideration all distributions across all plans in that group. Now, when a plan is considering whether to add these distributions, there's a couple of things to think about. First off, if you want to go ahead with these and go ahead and do these, you can start doing this now, and you don't have to amend your plan until the end of your 2022 plan year. So that's an advantage. You don't have to go through the formal amendment process first. If you have a pre-approved form of plan, your plan sponsor may be adopting these automatically. You're going to want to make sure you pay attention to that. They may have already implemented these for you. Now, they should have reached out to you about this at this point in time to let you know what they are providing or what your options are. But again, if you have a pre-approved plan, if they have decided to make a universal amendment, you may already be offering these and you may not know it. The other consideration is whether you think your plan already has sufficient other in-service withdrawal options that you don't need to add this. Some employers are a little more paternalistic, and they want to make sure that participants aren't draining their retirement funds, which is why you also may want to consider a limit lower than $100,000 if you go ahead with these. Now, these distributions have been getting a lot of press, and you're probably already getting requests from participants about these. You're going to want to be deliberative with this as to whether or not it's going to be helpful for participants to give them these distributions. But at the same time, balance whether you want to prevent participants from fully depleting their retirement savings, especially in light of the fact that certification requirements are fairly liberal. So as we've been saying, these distributions are available to someone who certifies that they're a qualified individual. Right, so that's a participant who has been diagnosed with the virus or with the disease, COVID-19. They have a spouse or dependent who has been diagnosed with the virus or COVID-19. The participant is experiencing adverse financial consequences from being quarantined, being furloughed, laid off, or having their work hours reduced because of the virus or COVID-19. They can't work because of lack of child care, or other factors that the Secretary of Treasury will tell us about in future guidance. Notably, these don't include a participant experiencing adverse financial consequences because their working spouse has been quarantined, furloughed, laid off, or unable to work. It's specific to the participant. We've also already encountered a question with respect to reducing work hours. Is that just losing overtime? Does it have to be a reduction in their regular hours? And there's no guidance on that yet. As I said, the CARES Act is specific that a plan administrator can rely on a participant's self-certification that they're a qualified individual. Depending on what that certification looks like, for example, if it lists all of these factors and someone is certifying that they satisfy one or more of those, as the plan administrator, you're really not going to know. For example, if the participant has been diagnosed or their spouse or child has been diagnosed, and you really can't question that. As a general rule, unless it's obvious that someone is giving you false information, you have to accept their self-certification that they're a qualified individual. And as I said, we really don't have guidance on any of these, like having work hours reduced. Is that just losing overtime, or does it require losing base hours? If you read it as written as having work hours reduced, arguably it would include losing regularly scheduled overtime as well. Now, Being a qualified individual also entitles you to special benefits with respect to plan loans from your qualified plan. And John is going to tell us about the special treatment you get as a qualified individual with respect to plan loans.
Thanks, Tony. So there are a couple changes that are effective for loans from qualified retirement plans. I'm going to first talk about suspension of loan payments. So any loan payments that are due on a plan loan anytime between March 27th and December 31st are going to be suspended for 1 year. Now, the language in the Act that makes that possible is clear as mud, as they say, but it would seem to suggest that any payments that then become due as of January 1st or thereafter of next year will still have to be made. So even though they're suspending these payments for a year, you're going to have to start making payments again at the beginning of next year. At that point in time, the loans will be, re-amortized and you'll make your payments in their usual course. Now, during that point of suspension, the loans are still going to be subject to and credited with interest. So it's possible, a practical suggestion for people who do have loans is that you may still want to make payments. And so employers are going to have to figure out how to deal with that. Obviously, they're not required. It's not going to be a default of the loan. But if participants don't want to have the interest accrue and have this obligation, kicked down the road, so to speak, they're going to want to make payments. Now, this is applicable not only for loans that are outstanding, but then for any new loans that are taken during that period of time. The second piece then is the availability, and this is only for qualified individuals, which Tony just described, of the ability to take a new type of loan. Normally, loans are limited to basically $50,000 or the amount of the participant's vested account balance, whichever one is less. These new special loans for qualified individuals would allow them to take up to 100% of their vested balance or 100,000, whichever is less. So it basically doubles the available loan. Again, it's only in effect for loans beginning between March 27th and December 31st. And, this is a provision that, similar to the distributions, that employers will get to decide whether or not they want to put into place for their plans. So an employer does not have to offer these increased loans. There are some practical considerations that I think an employer should think about when it comes to these loans. First of all, if someone takes out a $100,000 loan, and let's just say it's a 3% interest rate, they can wait a year before they have to start repaying that. But then at that point, they're going to have to make payments of $1,850 a month for 5 years. And that's on an after-tax basis. So they're going to have income of, likely greater than $3,000 a month just for the payment of those loans. That's a pretty significant burden on a lot of employees. And so in addition, obviously, this is an administrative burden on an employer that offers these loans, because you're going to have to go through the loan documents. You're going to have to re-amortize the loans. You're going to have to figure out how to deal with these increased obligations on the part of the participants. And so we're seeing a number of employers decide that, they're not going to offer the loans, that they'll just offer the distributions that Tony described. But if you do decide to offer the loans to participants in the plan, you also have to take a look at whether or not your plan has a limit on how many loans can be outstanding. A lot of times plans limit to 1 loan or to 2 loans. And by adding this one, you may want to consider allowing an additional loan so that participants can have access to this if they need it. So I guess the real question comes down from a practical standpoint. If both of these are available to participants in the plan, which one is likely to be taken? And I'm sure if we asked 10 people, we'd get 10 different opinions on this one. But I think because of the flexibility and the tax benefits that were described by Tony with respect to the distributions, unless a participant is just definitely confident that they'll be able to repay their loans and repay them timely and easily, they're probably better off taking the distribution. And the reason why I say that is, the loans are, they don't have any tax ramifications when you take a loan other than if you go into default. If you don't pay back the loans when they're due after you reamortize it and so forth, then the full amount of the outstanding loan, including accrued interest, becomes treated as a distribution to the participants. And unlike the distributions that Tony described, these would be subject to an excise tax if you're not 59.5, and they'd be subject to immediate taxation at that time rather than over the 3-year period that was described by Tony. So if there's any possibility that a participant's going to have trouble making back these loans, it'd be much better off taking the distribution because they have up to 3 years to effectively retroactively make those tax-free by rolling those amounts into another qualified plan or back into the plan. So if you're stuck between the two of those, I think it's pretty clear that the distributions are probably the better result. And as a result, we've seen a lot of employers just say, hey, we're not going to offer them anymore. It just doesn't make a lot of sense. So I'm going to turn it back to Tony to talk about the changes that have been made to the required minimum distributions.
Sure, thanks, John. As many of you probably know, when you're calculating required minimum distributions for a year, you start with the balance as of the end of the prior year. So when calculating required minimum distributions for 2020, we're looking at people's account balances from December 31st of 2019, which are very, very different from what they are right now. And in recognition of the fact that folks could be taking out a lot more money from their depleted accounts now, kind of the opposite of the coronavirus-related distributions, to allow people to not force them to take money out that they don't need or they want to take less out because of the drop in the market. Anybody who would be required to take an RMD in 2020, which would be anyone who attained 70.5 before January 1 of this year, not required to take that distribution in 2020, whether it's from your qualified individual account plan, like a 401k plan or another profit sharing plan, or an IRA. This rule does not apply to defined benefit plan distributions. That said, many plans have it written into their plan terms that you have to take a required minimum distribution, because one of the things that the IRS doesn't allow us to do is incorporate those rules by reference into the plan. So they're all stated and laid out in the plan document themselves. So if the plan is going to suspend that requirement for 2020, they would have to amend the plan. As I said before, if you're in a pre-approved type of a plan, a volume submitter or a prototype, the plan sponsor, the master plan sponsor, may have already decided that they're going to adopt the universal amendment, eliminating the required minimum distributions for 2020. If you're not in one of those types of plans, or if you or some master plan sponsors may give you the option as to whether or not you want to still require those distributions in 2020. Leave the plan the way it is, which you can do as long as you can account for and properly report the fact that the required minimum distribution made in 2020 is actually eligible to be rolled over. So somebody who you force to take this out isn't really going to be harmed by it because they can roll it into an IRA and defer the taxation. Not going to be a problem there. The other piece that you want to think about, and actually the question's already come up a couple of times for me, someone who already took their required minimum distribution for 2020 now wants to roll it back into the plan. And that's going to depend on what your plan's rollover language says. Some plans will allow it, some plans won't. If your plan doesn't and you want to allow them to bring that money back in because they didn't have to take it out, you would have to amend the plan. Again, this is something that you can do now. You don't have to amend the plan until the end of the 2022 plan year. So it's another one of those situations where you can implement now and then
touch up the plan document later. So we've talked about participants wanting to get money out of the plan or not take as much out of the plan as so far. But there's also the other side of this of employers finding ways to not have to put money into the plans during this current financial situation that they're in. And Dale, you want to walk us through some of what those considerations are and what options employers will have?
I will. Thank you, Tony. And as Tony mentioned, obviously employers are struggling. I don't have to tell anybody in the audience that. A lot of businesses are shut down. Businesses nowhere near as good as they hope. Not most. There are some that are doing well. And the question comes up is, well, I want to stop making contributions, and maybe at least to figure out what's going on. Maybe just to get my feet back on the ground. And if you're going to reduce or eliminate employer contributions, you have to do so carefully and follow the rules. And these rules have been around for a long time. This is not something that's part of the CARES Act or anything like that. These rules just exist out there. And you really got to depend on what kind of contributions we're talking about. If we're talking about discretionary contributions that the employer gets to decide on a year-by-year basis whether to make and into what amounts, that's fine. There's really no amendment or anything needed to the plan document because the plan document already gives the employer that flexibility to make that decision. And they may be discretionary contributions like the old-fashioned profit-sharing contributions. They may be discretionary contributions like discretionary match contributions. Because it's already in the plan, there really isn't any required notice or anything you have to give to employees. Now, that said, if we're talking about you want to eliminate discretionary matching contributions, I think it's probably a good idea for employee morale and everything else to let people know that you're going to do it, and probably maybe even think about doing it with respect to employer profit-sharing contributions if that has just been a routine thing that the employer has done in the past. Just let people know that you're not making it or you're reducing it just to avoid unpleasant surprises. But then we have non-discretionary contributions. There may be language in your plan document that says you will make a contribution of so much or you will make a matching contribution. If you want to change that or eliminate that, especially if you want to take it to zero, you will need to amend the plan to do that. You need to do a plan amendment, and because it's a plan amendment, you're going to need a summary of material modification. And certainly it'd be advisable to provide anybody with notice with respect to matching contributions that you're eliminating a non-discretionary, a mandatory contribution to the plan. Now, this amendment that we're talking about isn't anything that falls under the CARE Act amendments that Tony was talking about. You're having until December 31st of 2021 to make your changes. If you're doing that, you need to do it now, and it needs to be adopted in this plan year. So you don't get an extension on that. I mentioned ESOP considerations. ESOPs are kind of depending upon the plan itself, have almost contributions that are required. They may not be totally non-discretionary. I mean, you have some ESOPs that are leveraged, so the ESOP has borrowed to buy the stock that is put in place, either from the employer or from the selling shareholder directly, or maybe some combination of the two. And one of the things that for ESOPs is that when that loan was put in place, whether it's to the employer or to the selling shareholder or some combination, the employer had to promise as part of the deal, so this was not a prohibited transaction, had to promise that it would make enough contributions or dividends or S-corp distributions such that the plan could handle the debt service. Now, it's no big deal, if you will, if the loan is between the ESOP and the employer puts the money in, the ESOP takes the money, turns around and gives it right back to the employer. So the employer doesn't have that money for however long it takes to complete that circular route back. But it's different if the money is going to an outside selling shareholder and who may be relying on that money and so they're not interested. People may be tempted if you're in a leverage situation with an ESOP to say, well, yeah, things are tough right now. We've got some cash flow issues. Let's lengthen our loan. Maybe we've got a 15-year loan, and we want to make it longer, make it 25 years. You got to do that very carefully. It's not that you can't do that, but going back to what I said a little while ago, is the employer has promised that it will make sufficient contributions or get sufficient money into the ESOP to handle the debt service on a 15-year note. It promised that. Now it wants to extend it. The Department of Labor has been adamant over the years. Really, this started back in the recession of 2008, where a lot of this came up. Been adamant that if you want to extend that note, the ESOP needs to get something for that, because the company's promise. So you're asking the ESOP trustee to give something away. So you need to. You can't do it, but you need to give the ESOP trustee something. Maybe it's faster vesting. Maybe it's a promise of a match in the 401k. Anything like that if you want to extend it. Because of that, because of the difficulty of trying to extend a note, we've typically done fairly long notes. Because you can always pay faster. You just don't have to jump through these hoops in terms of trying to extend it after the fact. Now, there are different types of, see if we can make that move. Okay, whoops, too many times. One of the issues that a lot of employers have with respect to their plans is dealing with safe harbor plans. Safe harbor plans, I think this group is familiar with, are 401k plans that get an automatic pass on their testing if they do certain things. Either there is 3% non-elective contribution that goes in for everybody, and really is vested immediately, or there's a match. And before the year starts, you gave out a notice. You told people how that would work. And so these plans are mandatory contributions. You're doing it to pass your 401k, special 401k testing. And how do you do that? Well, the regulations permit mid-year changes to a safe harbor contribution, whether it's a match or a non-elective, only if the annual safe harbor notice that you gave out stated that the employer might stop contributions, or the employer is operating at an economic loss. I think virtually all safe harbor notices these days include that language that the employer might stop contributions if that's the road you want to go down. But take a look at the notice you gave out back in the end of 2019 to see whether it has that language in it or not. Probably does, but take a look. If it doesn't, then the employer's got to be operating at an economic loss. It's probably easy to demonstrate given what's going on right now, but you need either of those. You just simply can't do it. So you got to take a look at that. And if that's what you want to do, then the process, you've got to amend the plan. Once again, it's got to be timely. There's no long extension like there is with the CARES Act. You've got to provide a 30-day advance notice that you're going to do that. Now, this gets a little confusing. I don't know if people were paying attention. The Department of Labor came out yesterday and gave a whole lot, in conjunction with the IRS, gave a whole lot of extensions, kind of good faith compliance, timing of various notices that you would have to give during the time of all this craziness, and kind of extended those out. It's not really clear in my mind whether it applies here or not, because you're still supposed to be doing kind of a good faith compliance. And if you're going to stop it, I would recommend that, notwithstanding that notice, that you still do the 30-day advance notice before stopping a match or non-elective. And if you do that, be careful, because now you got to test. The fact that you may be stopping it now here, and start in May, not going to do it anymore. and you still got the obligation to make the contributions for the period from January through the end of April, you still got to make those contributions, but you don't get a free pass for that period of time. You got to test the whole year. And so you've got to be able to do that, and you've got to prorate compensation and a whole bunch of things in terms of doing that. You've also got to watch, because one of the things that being a safe harbor plan did, if that was the only contribution you didn't have to worry about top-heavy issues. So the plan, 60% or more of the benefits are going to key employees, and there's a required minimum contribution. You didn't have to worry about that. If you had a safe harbor plan and only making contributions for a select group, and we're taking advantage of it, be careful. Not only you got to pass the ADP, ACP testing, you've got to worry about the top-heavy issues. Then we get into things that kind of go along with this. As you're dealing, we talked about the fact, qualified individuals, or people have reduced their hours and so forth. But a lot of employers have been, laying people off, furloughing people, or terminating people. Part of it is, what does that mean? I mean, termination is pretty clear that, you terminate, the employment relationship is severed, you're gone. We close this facility, we're not reopening that particular restaurant. Everyone's let go. Layoffs and furloughs, in my mind, are kind of fuzzy little terms in terms of what they mean and whether or not there continues to be an employment relationship. Unless there's some contract or a union contract or something along those lines, that it's not really clear what a layoff means and a furlough means. Furlough seems to imply that you're kind of like on an extended vacation, and that you still have some employment relationship. Being laid off has a little bit of that too, but sometimes layoff is just, it may be a softer word of saying, well, we terminated you, but we didn't want to call it termination. We call it being laid off. But it's going to be not critical, but at least, you're going to have to look at it to say, all right, if I clearly terminated the person and the plan allows distribution on termination, that's fine. But now we get into layoff. Is it really the employment relationship has been severed such that it's a termination, you can get your money? Not really clear. Furlough, in my mind, seems to imply that no, unless there's some other term in the plan that allows you to get a distribution, you're still going to need to do that. Still going to, have to stay in the plan, and maybe you've got the CARES Act distribution features that Tony was talking about. But it also creates other issues besides deciding whether or not you're entitled to a distribution. Is, well, you're crediting a service. I mean, the normal rule, you're crediting hours of service for every hour that you worked or paid for. And this can include periods of time where you're getting paid and you're not working. For example, the Family First Coronavirus Response Act, has smaller employers, giving people paid leave. Well, you're going to wind up getting credit for service under the terms of the plan and the normal course of the way things work. Now, because you're getting paid for not really working, you may be able to limit it just to get up to 501 hours of service so you don't create a break in service. So that may be there, but you got to watch that. The other thing with these payments is that's compensation. It's probably going to be W-2 compensation. And if your plan uses a W-2 definition of compensation, this is going to be included in their pay, and you're going to be since you are still making contributions, you'll be making contributions based on that. So you just need to focus on it. If you don't want to do that, not make a contribution based on that, you may need to amend the plan to do it. It may be difficult if you're dealing with a pre-approved plan and you can't really tinker with those definitions. So you need to talk about that. Before I leave this slide, in terms of the layoffs and terminations, one of the things that should have mentioned when we're talking about doing these kinds of changes, if we're talking about a plan in the union environment, clearly you can't simply make these changes unless they're discretionary sessions of payments. You can't simply do it. If you're going to eliminate a payment that's a mandatory payment, a non-discretionary payment, you're going to have to negotiate that. A question was raised, and is what do we do with union plans? So we want to terminate these plans. Well, you can't really terminate these plans without negotiating the termination. And if you're in a multi-employer situation, once again, you have to negotiate it, and then you run the risk of withdrawal liability. And I'm not turning this over to John at this minute, but John has a lot of experience dealing and helping with employers dealing with that. So if you want to talk about those issues. One more, which is kind of a hidden issue, has been around forever. Every plan, I think people know, every plan has to provide that when the plan is terminated, everyone in the plan becomes vested. But there's also this concept of a partial termination. And the law has been around since 1974, 75, that a partial termination of the plan also requires affected participants to be vested. And what this is and where this comes from is if the employer has taken an action such that a substantial number of employees are terminated, so they're not continuing to go in the plan, not continuing to move along the vesting schedule, they need to become 100% vested because the employer has taken an action that's caused them to be excluded from the plan. And there's no guidance in the law on how big that is, but the IRS over the years has come up with the concept that a 20% reduction is substantial enough to create a partial termination. And so if we have that, and it can be caused by one event, it could be caused by multiple events. So we lay off one group of people now, 3 months later, another group, 3 months later. And even if you cross plan years, the IRS has been known to come back and say, no, it was one big partial termination because it all came from the same event. And what that means is that group of people that were left become vested. So just something you have to watch for, not saying that, you shouldn't let people go if you need to. But that's where we got to worry about that and keep an eye on it. And you may not know, you don't need to know today. You may not be, until the end of the year because you might let people go, then bring them back before the end of the year so that they can continue to move along the vesting schedule. So it's not a decision you could make today. It may be a December 31st decision. I think one of the things that I think we all know is this has affected retirement plans significantly. But John, I think this also has some health plan issues that we need to be dealing with.
Oh, yes, it does. Here, let's go down. So there are two basic, areas that the acts have impacted on the healthcare plans. I'm going to start off with the mandates. And these were put in place, actually first implemented by the Families First Coronavirus Response Act, which was passed in early March, and then were enhanced by the CARES Act. So we get to read lots of pages to figure out exactly what was done. But they impose mandated coverages on medical plans. And so the first question is, what plans are covered by this? And the answer is basically all medical plans, whether they're self-insured or fully insured, whether they're maintained by private companies or public entities or even churches. If they're a group health plan, that's going to cover virtually any one of your health plans, unless it's just a retiree-only coverage that doesn't have employees, or a flexible spending account, or something of that nature, or a short-term duration plan that is very limited in what it's intended to do. It's going to have to provide these mandated benefits. That probably applies to virtually every one of your medical plans. It doesn't apply to a flexible spending account in the sense that those claims, if you pay for them, would be qualified medical expenses and therefore reimbursable, but it's not being provided free of cost. So what are the benefits that have to be provided? Well, first of all, it's any FDA-approved provided service or item whereby that ultimately results in the administration or an order of a COVID-19 test. So that's the first piece. If you go to a doctor, call a doctor, go to the emergency room or whatever, and ultimately you are given a test based on what you provided, then all the things that are associated with that will be covered under this mandated benefit. The other one are any, again, FDA-approved items or services or immunizations that are incurred as part of the evaluation of whether or not you need the test or the furnishing of the test, or that are designed or intended to prevent or mitigate the actual disease. And these services, again, can be provided by telehealth, which was basically a concept that I wasn't all that familiar with prior to this, but it's now built into the Act. Or it can be in an office visit, it could be done at a clinic or even an emergency room visit. Any of those are provided. What period of time must these be provided for then? So it started on the date of the enactment of the Families First Act, which was March 18th, and it'll run through the date that there's a state of emergency ends, which I think is June 16th presently, but stay tuned, that could easily get pushed further back depending on how things go. So we should be aware of that. What are some of the other rules? Well, one is that these covered services, these mandated services, have to be provided free of charge. You can't impose deductibles or co-pays or any other kind of cost-sharing arrangement. They just got to be provided without cost. Two, you don't need any pre-authorization or medical management. In other words, a lot of plans will limit or turn down costs if you don't get pre-approval. You don't have to do that here. Now, I'm still telling you, if you think you need a test, call your doctor or call the hospital and make arrangements. Don't just show up, but you don't have to call your insurance company. Three, it doesn't matter whether where you get these, basically, as long as it's approved. It doesn't have to be in-network. It doesn't have to come from an in-network provider, which is helpful because, again, a lot of the networks are pretty limited, and you can go pretty much to any carrier that's able to provide these, and they'll be covered. And lastly, doing these do not impact or change a plan's grandfather election if they're still, we still have some companies that are grandfathered under the Affordable Care Act. And this, making this changes will not impact that, nor will it cause a health savings account or an HRA, health reimbursement account, to lose their status because you're providing additional benefits or you no longer have a quote unquote high deductible plan. So this is all good news for employees. I'm sure we're concerned about how are they going to pay for these coverages and these costs, and we'll go from there. So the next then, let me just advance this. Oops, my apologies. Is what other, my apologies. Okay, what other medical and health related plan issues, were created by this? And one of the big ones that we get a lot now are, hey, what happens to these employees who we have temporarily laid off or are on furlough or on some other kind of leave? Do their benefits end? And the answer to that is you have to look at the plan itself. It's going to be determined by the terms of the plan. Most plans provide that in order to be eligible to continue to participate in the plan, you have to be an active employee and you have to meet that definition, which is usually providing 30 or more hours of service per week or on a full-time basis. So if your plan provides for that and you lay someone off, now if we're paying for them or they're on vacation or some other approved leave where they're being compensated, then arguably they won't lose that coverage because they'll meet that definition. It works pretty similar to the rules that Dale was kind of talking about before. But if they're not being paid, then most plans would provide that they will lose coverage, and whether they lose it immediately when that happens or at the end of the month just depends on how your plan works. So from a practical standpoint, what can you do about that if you want to help your employees? They're on layoff, they're not getting paid because you can't afford it, and yet you don't want to take away their health insurance. The answer really depends on what your plan says and what you can make it say. So if you have a self-insured plan, then you can certainly go ahead and amend that plan to provide for those employees to continue to stay covered under the plan for a period of time. It's a cost that you'll have to pay, being self-insured. And you may also then clearly want to negotiate with your your reinsurance, if you have any kind of stop loss insurance or anything like that. You certainly will want to make sure that they are going to wrap that into their coverage, because you don't want to go bare on that. If you have an insurance product, in other words, you are simply paying a premium every month to the insurance company and they're the ones that are managing it, then I think you need to talk with your broker and with your attorney or whoever helps you with these things and decide what it is that you can and cannot do. They may not be willing to amend their plan or to provide for such coverage, or if they do, they certainly are going to expect to get compensated for it. Perhaps just the standard premiums are enough, but it's something you're going to have to negotiate. So, I guess the practical considerations here are, you should review your plans and policies and see what it is that they provide, and then you can decide what it is you want to do if it's different, and then talk with your insurance agents and your lawyers or whoever else is advising on these things to figure out how to make those changes. I would also suggest that anything that you do ultimately change, you get the insurance company or your, whether it's a health insurance provider or the stop loss policy provider, you get them to confirm in writing that this is acceptable to them. And then lastly, you should advise your participants and your beneficiaries and dependents as to what those changes are and how it's going to apply to them. So what other medical and health plan related issues are there to think about? Well, one was COBRA. We get this question a lot as well. And this really does totally pair with the prior thing I just talked about, which is COBRA does not kick in automatically because you've been laid off or furloughed or changed in any way from full-time to part-time. It kicks in because you've lost your coverage in the plan as a result of such event. So if your plan does not terminate their coverage simply because of that change, then that's not a COBRA event. You don't have to go out and give COBRA notices. But if it does, they do lose coverage, then you're going to have to treat that as a COBRA event, and you're going to give them the option of continuing to stay in the plan, of course, paying the applicable premium, 102% of the standard cost. And as a result, that's when COBRA will, be effective. Lastly, the acts did make a change to flexible spending accounts, HRAs and HSAs. And that change was that it retroactively made effective as of January 1, 2020, the fact that over-the-counter drugs and menstrual-related pharmaceutical items will now again be treated as qualified deductible medical expenses under such plans. Some of you may remember that used to be the rule, that you could, for a period of time, that you could be reimbursed for your over-the-counter drugs and things like that. But that was taken out by the Affordable Care Act in 2010. And so until January 1 of 2020, you couldn't do it over that 10-year period. We're now back to being able to do that. So that's good. That should help. As a practical suggestion, though, I would say that you want to make sure that you think this through. If you have a flexible spending account and somebody is able to do over the counter, you don't want them at the end of the year buying 5 years worth of items or anything like that and expecting to be reimbursed for that. And for those of you that deal with flexible spending accounts, you may also remember that the company does have exposure to risk with those, because if I make an election to take out $200 a month for the course of the year, I can submit a claim for $2,400 on January 2nd, the second day of the year, and the company has to pay that. And the only way they get reimbursed is if I remain an employee through the remainder of the year. Well, you're not going to want that person who's leaving to go to the pharmacy and buy all sorts of drugs to cover them for the year and have the employer pay for that. So you may want to think about implementing rules and how that's going to be applied. And fortunately, again, I think that based on the ruling or the guidance that we got yesterday, I believe, from the Department of Labor and the IRS saying that there's the notice provisions are not suspended, but we're going to be a little bit practical about how we apply them. You're going to be able to make those kinds of changes. So I'm sure we have some questions. Let's move it on to that, Dale.
Yep. Yeah. Well, we do have some questions. We have some time left, and you could still be submitting some questions, but we do have some. Tony, I'm going to address this one to you. How about a termination distribution that's not a rollover? Would that still apply to the no penalty rule if the certification is made? And if so, would the termed employee be certifying this to us, I assume the employer, or on their tax return?
Okay, if the distribution's already been made because it's made under the plan's provisions regarding a termination, somebody's terminated and they've taken their distribution and it's already happened, they didn't roll it over, they would be able to avoid the penalty, the early distribution penalty, but they would be certifying that on their tax return. It's they've already got the distribution. The only benefit to certifying it prior to the distribution to the plan is that the mandatory withholding wouldn't apply. But once the distribution is made, the individual, if they're a qualified individual, can still avoid the penalty. But again, it's going to be something they're going to do on their individual tax return. It's already out of the hands of the plan, and the plan really has no control over the penalty. It would just be how the plan reports it, but they could still say they're a qualified individual. It's a distribution during 2020, and they can avoid the penalty when they file their tax return.
Great. If somebody takes a real coronavirus distribution, Tony, I mean, they certify, they come in and they take it, can they use it for any purpose, or is it limited, or how's that going to work?
Once they certify that they're a qualified individual, that's really all that the plan administrator needs. They don't have to say what they're going to use it for. They don't have to provide any documentation as to what they used it for after the fact. They just say, I'm a qualified individual. I've had the virus. My spouse has had the virus. I've had adverse, financial impacts from one of these things. And that's all the plan administrator needs to know. There's no requirement that they, account to anybody for what they're using it for. So yeah, once you meet that threshold of being a qualified individual, they can use it for any purpose they want.
Great. Well, John, we've got a question for you. Plan loans. Does a plan participant have to be active to take the loan? Or if they're inactive or furloughed, can they take a loan?
And again, this is a great question. The Act does not make this a requirement. So there's nothing in the Act that says that you have to make it available to non-active participants. So it's really going to come down to what the plan provision says and how you elect to implement the new rule if you elect to implement it. Most plans do not allow non-active participants to take loans, and for a very logical reason. The idea of a loan is that we tend to use a payroll withholding to pay those back. So we have an easy way to make sure that the plan is repaid. And if you're not an employee and not receiving a paycheck, that makes that more difficult. It's not impossible. We could always have the person send checks into the plan administrator, but just most companies and most plans do not allow that. So I guess the answer is, in most plans, no, you would not be able to take a loan if you're inactive. You'd have to take a look at the distribution provision and see whether you could cover yourself in that way. But by plan could be different.
Okay. Well, we do have a couple of health questions, John. You're on a roll, so we're gonna keep you there. Is plasma or antibody testing included in the COVID-19 testing without cost to the employee?
And again, it's got to be done, and I will not pretend to be a healthcare expert when it comes to these types of questions, but the Act does say that it has to be done as part of the diagnosis or the mitigation. So if it's being done to determine whether or not the person has the disease or needs the test, then it's likely to be covered. If it's being done after the fact to see whether the person has antibodies or whatever it is, then we're going to have to wait for further guidance to know whether or not that will also be covered.
Okay. It's going to be an interesting time. A lot of people are going to be busy in Washington giving us some guidance here. Another question, somebody's asking for some guidance. Has there been any ruling on extending the time period for spending down an FSA account? If the employee is on a fiscal July to June, they probably haven't been going to the doctor or spending it. Is there any talk of an extension about spending the funds? Because we're not really able to spend it.
As you may be aware, as you may be aware, there may be your plan could have a provision that would allow some portion of $500 of the amount to be rolled over to the next year, or it could have a provision that allows you to use it for expenses occurred within the first couple months of the next year. Those are both permissible under an FSA, not both, but either. But there hasn't been anything that I have seen that suggests that they're going to kick this down the road and basically eliminate the use it or lose it altogether for this. Now, the other question, though, is whether you can change your FSA election in light of this. And again, there's a lot of talk out there about that as to what events would be a change in status that would permit you to change your election going forward. For instance, if you're at home not working, that's obviously going to be a big change. If your child is home and not at school or with a caregiver, that might be a big change. So there's going to be more guidance, I'm sure, on that as well. But that would at least allow participants the opportunity to maybe change their election for the remainder of the year so that they don't end up with a huge amount taken out that they can't spend, or so that they don't end up with huge expenses that they can't figure out how to do on a pre-tax basis.
Good. Well, I'm showing it's 1 o'clock, maybe a little after, depending on which clock I'm looking at. Like multiple clocks here. That's the end. We promised to be finished at 1 o'clock. As you can see, there's lots of stuff going on. There's lots of stuff we don't have any knowledge about. We're waiting for guidance, and we assure you that we will, McDonald Hopkins and the Employee Benefits Group, will continue to follow and report on the latest developments concerning employee benefits plan in the time of coronavirus. If you have questions that did not get addressed, please email events@mcdonaldhopkins.com or contact one of us individually. I believe you have our email and information on the screen in front of you right now. We're happy to talk to you. On behalf of McDonald Hopkins, the Employee Benefits Group, we thank you for joining us. We hope that you and your families remain safe in these times and stay healthy. And thank you again for joining us.
Thank you very much.